When you were a child and you kept misbehaving and then your parents came to you and they're like, that's it. This is the last time. If you do this one more time, I'm going to spank you. That's the kind of warning that Jerome Powell came out and gave. It's really more of a threat. Hi guys, it's Doc Harry, and the Fed meeting minutes came out on Wednesday, and Papa J. Powell just gave a warning, well, more of a threat really, to all investors. This is one you're going to want to pay attention to, so let's get into it. Prior to the Fed meeting minutes coming out at 2 p.m., the job openings numbers came out around 10 a.m., and they showed that the labor market is still strong, with labor demand remaining strong as well. Now, this initially sent the stock market down because a strong labor market points to the possibility of the Federal Reserve doing more interest rate hikes, and that would be bad for the stock market. But then the stock market seemed to ignore the news and recover. That was until the Fed meeting minutes came out. The Fed meeting minutes didn't have a lot that was shocking. It reiterated what Jerome Powell was already saying, though, that Fed officials see higher rates for some time ahead. Now, one thing that's kind of interesting about what's happening lately is that the stock market and the bond market don't believe the Fed. The Federal Reserve and Jerome Powell is coming out saying they're going to do one thing, and the stock market and the bond market are not falling, indicating that they don't believe Jerome Powell. So one interesting note in the Fed meeting minutes where Jerome Powell made it very, very clear. The FOMC meeting minutes clearly stated that no FOMC members expect rate cuts in 2023, despite the market pricing in a rate cut this year. Now, why would the Federal Reserve be so worried about what the market expects to the point where they had to explicitly put this statement into the Fed meeting minutes? Well, the reason is because in order for the Fed's raising of interest rates to work, the Federal Reserve has to work through monetary policy, meaning financial conditions have to tighten. There has to be less people buying houses, less people buying cars, and less people investing in the stock market. And if the stock market is not falling, and in fact is even rallying, that's not good, because that means that the work the Federal Reserve is putting in is not working and inflation's not going to come down. And that's why the Fed meeting minutes show officials feared that markets' optimism could complicate the inflation fight. Officials flagged concerns that their effort to lower inflation could be more difficult if markets rallied, in part as evidence accumulates that inflation is slowing. As more CPI reports come in showing inflation slowing down, the markets are going up, thinking, okay, that's good. The Fed is going to slow down and possibly even start cutting rates. And the Federal Reserve is saying, wait a second, stop going up, markets. We need you to keep going down. Ignore the inflation reports coming out saying that inflation's going down and just keep selling off. That's what the Fed wants. The Fed's rate-setting committee is trying to slow down spending, investment, and hiring in order to cool inflation. And while lower CPI reports have been welcome, they stressed that it would take substantially more evidence of progress to be confident that inflation was on a sustained downward path. What's also interesting is that several officials are shifting their focus from broad inflation readings to the labor market amid concerns that high inflation could persist if it leads workers to bid up wages. Wage growth has not shown meaningful signs of slowing down, particularly as companies offer higher wages in order to attract new workers than they pay their current workers. What Fed officials are concerned about is something called a wage price spiral. As wages continue to go up, this gives employees more money to spend, and that in turn causes prices to go up because demand remains high, and that triggers a wage price spiral. And that means inflation continues to go up. It does not come down, and that is not what the Fed wants. This is the new Fed concern. It's not necessarily the inflation reports, but rather wage growth, which could cause inflation to go up in the future. And this is where Jerome Powell stepped in to give a warning to all investors. And I'm not just talking about the kind of warning where it's like, yeah, okay, Jerome Powell, whatever. I'm talking about the kind of warning where when you were a child and you kept misbehaving and then your parents came to you and they're like, that's it. This is the last time. If you do this one more time, I'm going to spank you. That's the kind of warning that Jerome Powell came out and gave. It's really more of a threat. Jerome Powell said the Fed would raise interest rates to higher levels for longer if broader financial conditions don't reflect the policy constraint that they're putting in place to bring inflation down. Jerome Powell is threatening that if the stock market doesn't start selling off and wages don't stop rising, then Jerome Powell is going to come in and they're going to raise interest rates even higher than people expect, and they're going to keep them there longer than people expect. Jerome Powell is going to do whatever it takes to slow down investing and slow down the labor market. And if that means doing even more than he said he would already do, then so be it. Jerome Powell's not playing around. He is going to come out here and he's going to do whatever it takes to get the stock market down, and he's going to do whatever it takes to get the labor market down. So if we don't start seeing some turnaround, which clearly we have not seen any sort of turnaround in the labor market in November, and the fact is the stock market really hasn't sold off that much in the last few months. So signs are that the stock market employees, they just don't believe Jerome Powell. They don't think he's actually going to do this. So now we're kind of at a standstill. We got the child, who are the investors, and the employees who are saying, yeah, right, whatever, Jerome Powell, I don't believe you. And you got Jerome Powell, the big daddy over here, saying, that's it, I'm warning you one more time, and I'm going to spank you with higher interest rates. So we'll see what happens, but this is interesting as a standoff to see what's going to happen in the future. Keep in mind, the next Fed meeting is about 1 month away. Now, one area where the economy is seeing a slowdown is in the housing market. And Manhattan apartment sales have now plunged in the fourth quarter as brokers fear that the market is frozen. There were only 2,312 contracts signed in the fourth quarter, which was down 43% over the last year. Contracts signed are a timelier indicator of demand and registered one of the slowest finishes to any year since 2008. Now, I hate to keep comparing the economy to 2008 because we all know what happened in 2008, but that's the reality that we're currently in. And layoffs continue to increase as well, with Salesforce now cutting 10% of its personnel, or more than 7,000 employees. Now, so far, the job reports are showing that as employees get laid off, they're finding other jobs relatively quickly. However, even a short-term amount of time without a job could have devastating financial effects on a lot of employees, especially if they don't have a lot of money in their savings. And this is showing up in another way, kind of a red flag that things in the future might turn really bad. The share of new car buyers with a monthly payment of more than $1,000 a month has now hit a record high. More than 15% of car buyers are now paying more than $1,000 a month. That is the highest in history. And with those kinds of payments, even a slight slowdown in the economy, whether that be through more inflation or the loss of a job, or maybe just not getting a promotion in the future, any of those things could cause people to become underwater on their car loans. And this is especially going to be a problem as used car prices continue to decline, and everybody who bought a new car is very quickly underwater and very quickly owes more than the car is actually worth. And when that happens, you see repossessions skyrocket. And we already have seen repossessions hit the highest level since 2008. And now signs are indicating that repossessions on cars could go even higher. So this is a major red flag for the future. Another indicator that we could be heading for a recession here in 2023, something that you're going to want to keep your eye on. Now, if you want to know how we're trading this and how we're making money as the market goes down, it is through a combination of swing trading with options as well as day trading options. If you want to know what we're actually trading and how you can start playing options to make money as the market goes down, then I encourage you to come join my options trading course and the coaching program that I have set up to help you learn how to trade options. If you want more information on that, you can schedule a call with an onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you enjoyed this video and got a lot out of it, then be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. And make sure you hit that like button and subscribe. And if you want more great market insights and a few predictions on where we see the market going this year, then I encourage you to watch the last video that I uploaded here.